Facts. Hey gang, in this video we're gonna laser focus in on how to properly classify and categorize our assets and liabilities. We understand that they belong on the balance sheet, but we need to know the correct order in which we report them. And by the end of this video, you'll be able to categorize those accounts in your sleep. Okay gang, so from our previous videos, we already know what are asset and liability accounts. Our asset accounts are economic resources that provide some type of future benefit. Liability accounts are those economic obligations or claims against those assets by outside individuals. I like to use the short terminology as things that we owe. And so what you must understand is that our assets are broken down into two main categories. We have current assets and we have long-term assets. So our current assets, by definition, are any assets that are converted into cash within 12 months or operating cycle. In contrast to the long-term assets, our long-term assets are the assets that we hold or we don't convert into cash longer than a year. And so on the balance sheet, we list our assets in order of its liquidity. Now, liquidity is just a fancy word for how quickly we could convert something into cash or flip it into money. So in this particular time, I like to give you examples of the correct order of the liquidity of current assets. Cash, accounts receivable, inventory, supplies, prepaid expenses. And those pretty much consist of all of your current asset categories as of now. So what about the long-term assets? Well, those long-term assets, we hold them longer than a year. More importantly, most of our long-term assets we buy to help us generate income, help us generate revenues particularly. Because remember gang, we're either providing a service or selling a product, but we need certain assets to help us do that. Particularly the long-term assets help us the most. So with that being said, let's discuss the long-term assets. Long-term investments could be any type of outside investments that we make that we plan on keeping for longer than 12 months. Examples of that could be a note receivable or purchasing stock in another company, purchasing bonds from another company. Our next long-term asset will be plant assets, also known as property, plant, and equipment, PP&E. Now, property, plant, and equipment assets are the ones that get depreciated at the end of the period. What type of property, plant, and equipment assets we have? Obviously, equipment, furniture, machinery, things of that nature, buildings. Land is also considered a PP&E account, but remember gang, it doesn't get depreciated. And last but not least, our final long-term asset, as of now, intangible assets. So those intangible assets are the assets that we can't actually touch. They're intangible. So what are we talking about? Copyrights. For example, Nike.
Just do it!
That's a copyright. What about the check on the Nike? That's a trademark. That's also considered an intangible. We have patents. We also have franchise agreements. All of those are considered intangibles. And so that wraps up our assets gang. And all you have to remember is that it's going to be reported on the balance sheet in order of its liquidity. So let's move on to our liabilities. Now, the cool thing about the liabilities are, it's not a particular order in which we have to report them. But liabilities are still broken down into two major categories: current liabilities and long-term liabilities. And just like current assets, current liabilities are the liabilities that we expect to pay off within 1 year or operating cycle. In contrast, long-term liabilities are those liabilities that we do not expect to pay off within a year. So let's discuss quickly our current liability. accounts payable, salaries payable, interest payable, unearned revenues. What about our long-term liabilities? Those long-term liabilities, we won't pay off within a year. It's going to take a while to pay them off. So what would be examples of long-term liabilities? Notes payable and mortgage payables. Of course, there are more liability accounts, but for right now, those are the ones that we're going to focus on. So without any further ado, let's take a quick look at a properly categorized and classified balance sheet. Okay, gang, we have a beautiful left-handed version of the balance sheet, and I just want to quickly go through this so you can understand how to properly categorize and classify the accounts that belong on here. So first and foremost, we always start off with our assets, and as we know, they are reported in order of their liquidity, how easily converted into cash. So our current assets are as follows: cash, accounts receivable, supplies, prepaid rent, and we get a total current asset of $1610. And then we move on into our long-term investments, which happens to be our long-term assets. And so we have some investments that are of $1770. And then we go to our PP&Es. Since we only have one, we don't properly have to categorize a PPE account title. So we just went into the building itself, and we have building, and as we know, gang, the building, because it's a planned asset, is always reported at book value. So right under the building cost amount, we must always deduct the accumulated depreciation to give us our book value. And so we see we have a book value of $59.75. And after that, we reported some intangibles, which happen to be long-term assets as well, of $2,000. And then we get a total long-term asset balance of $97.45. After we calculate our total current assets and total long-term assets, we add them up together, and they will give us a total asset amount of $11,355. Then we move on to our current liabilities. And again, gang, our current liabilities don't have a particular order. Some companies prefer to list them in ascending balance or descended balances of the amounts. So basically here we just kind of shuffled them out. Accounts payable was first. We have some utilities payable, salaries payable, and of course, unearned revenue. That gives us a total current liabilities of $200. And then we migrate to the long-term liabilities. Again, these are the liabilities that we don't expect to pay off within a year. And so we have two accounts that pertain to long-term liabilities. We have our notes payable of $4,000 and our mortgage payable of $2,000. That gives us a total long-term liability of $6,000. And again, we are to add our current liabilities and long-term liabilities together, and that gives us a total liability of $6,200. We then move on to our stockholders equity, because we know our accounting equation. And our stockholders equity is always broken down into two parts: paid in capital, which is definitely issuing stock, and retained earnings. And so we always list it in that particular order. So we list our common stock of $4,800, followed by the retained earnings account of $355. We add those two amounts up to get our total stockholders equity, and we have a total balance of $51.55. Thus, adding our total equity plus our total liabilities together to give us a balance of $11,355, which happens to give us the same amount of our total assets. And that's how we know, gang, that our balance sheet is correctly reported. And so I wanted to just summarize a visual explanation of how to classify your current assets, your long-term assets, your current liabilities, and long-term liabilities on the balance sheet. As always, gang, it's been a pleasure hanging out with you guys, and hopefully you are moving forward to chasing the bag with this accounting information. If that light bulb clicked, don't forget to hit that like button, hit the subscribe button, and share this information with your friends, gang. As always, thank you. See you soon. Bags.